G'day expats, ladies and gentlemen. Welcome to a special episode of Expat Chat. I'm James Ridley and today we're doing something a little different. A few months back we ran a webinar called Coming Home from the United States, the financial and tax steps you need to take before you leave. And off the back of some really strong demand from listeners asking us to share it more broadly, we've decided to release a special two-part series podcast. The first part is myself and Martin Jack, one of the specialist financial planners here at Atlas Wealth Management, walking through the strategy and wealth side of repatriating from the United States back to Australia. Things like getting your timeline right, what happens to your US assets once you land, and the planning window you've got before you become an Australian tax resident again. Before we get into it, just a quick disclaimer. Everything in this episode is general information only, not personal, financial, or tax advice. Your situation will have its own nuances, so please seek advice from a qualified advisor or accountant before acting on anything you hear today, because some of it will resonate. All right, let's get into it. Here's Martin and myself on the strategy and wealth side of coming home from the United States. Good morning, everyone. Thank you for joining us. I'm James Ridley from the Atlas Wealth Management, and I'm joined today by my colleague, specialist financial planner Martin Jack, as well as Josh Ashman from Expat Tax Professionals in the United States. Today's session is about one thing, coming home. If you've spent years building a life in the United States and you're thinking about coming and moving back to Australia, there's a financial and tax side to that move that most people underestimate. We're going to walk you through the steps to take before you leave, as you're coming back, and after, because the order you do these in genuinely matters. We've structured this in two parts today. In the first part, Atlas will cover the strategy and the wealth side and talk a little bit about the Australian tax treatment. We'll talk about the sequencing, the assets, and then Josh will take it over and walk us through the US exit tax side, which is where things get super technical. So let's get into it. Quick bit of housekeeping. Before we start, everything you hear today is general in nature. It should not be taken as personal financial advice or personal tax advice. We don't know your specific circumstances, objectives, or needs, so please don't act on anything you hear today and treat it as tailored to you. If something resonates, and it probably will, the right next step is actually a conversation with a qualified advisor, a tax accountant, or a tax lawyer who can look at your actual situation. With that said, let's get into it. A quick word on who the Atlas Wealth Group is and who we are. For those who haven't come across us, Atlas, we are a leading provider of financial advice, tax and mortgage services built specifically for Australian expats. That's our whole focus, globally mobile Australians and cross-border families. We're regulated by three different regulators at the moment, ASIC, ATO, and the DFSA, and in the future that will continue to climb. We look after clients in more than 50 countries. Once we got to 50, we just stopped counting. It seemed like a nice round figure. We manage over 500 million in assets, and importantly, every one of our specialists holds a degree with postgraduate certifications. This isn't a generalist shop that happens to take expat clients. We cross-border is what we do every single day. Here's how we're going to spend our time together, running through the agenda. Firstly, repatriation planning, why coming home is a financial event in its own right, and what a good outcome actually looks like. Then the heart of the Atlas section, the three phases of repatriation, from planning decisions 12 to 24 months out, the critical pre-residency window, and then your first day back as an Australian tax resident. And then lastly, I'll hand it over to Josh, who'll take you through the US exit tax, whether you're even caught by it, the three tests that matter, and a couple of real case studies. We'll have time for some questions. So before we move into the next couple of slides, if you do have any questions, there is that question box. So please drop it in there. I can see some people acknowledging it, putting their hand up. They can hear us, which is great. So as we move through it, I'll collect those questions, I'll summarize them, and then we'll open up the floor at the end for a bit of Q&A. In the meantime, let's jump into it. Coming home is a financial event. So this is our core idea. When you've built a life up in the United States, you leave a financial footprint on both sides of the Pacific, in the US and Australia. Repatriation is that moment those two systems collide. and the order in which you act can genuinely be worth more than the actions themselves. 3 things that drive this. Firstly, you've got 2 different tax systems that are coming together on one timeline. The US calendar year and the Australian financial year, they rarely line up, and that mismatch creates both traps as well as opportunities upon your repatriation. Second, assets in the wrong place. A lot of US accounts and structures that made perfect sense while you're living there permanently become expensive or awkward once you're back in Australia and you continue holding them. Thirdly, residency changes everything. The way you're taxed shifts the very day your residency does. That's the thread that we're running through the whole deck. What to do before you leave and what to do after you have arrived back in Australia. What a good outcome looks like, summarising it. So 1, avoiding unnecessary tax on both sides simply by acting in the right sequence. A lot of tax leakage in these moves isn't inevitable, it's a timing problem. 2, protecting what you've built. So bringing your wealth home without triggering avoidable tax events along the way. 3, re-establishing yourself back in Australia and doing it properly. So getting your super investments and your structure set up for the long term, not just patched together on arrival. And lastly, number 4, it underpins it all, clarity and confidence. You want to know the plan before you board the plane, not be figuring it out after you've landed. That's what the rest of today is designed to give you, that plan. With that in mind, I'll now hand it over to Mr. Martin Jack to take us through the core of the heart for Atlas. Over to you, Martin.
Thank you very much, James. I think you provided a very good summary there. So good segue into the 3 phases. There's certainly a lot of steps in repatriating to Australia. Everyone's circumstances are unique, and whether or not you're just from the US or maybe you've got assets everywhere. So we have tried to condense it into 3 core phases today. So we'll go through them and save you questions towards the end. But let's jump into the first one, which James has already sort of touched on, and it's your single biggest and most valuable lever, which is pre-residency planning, because that's what we actually have in our control. The moment that we come back to Australia, we've effectively lost that lever. You know, pre-residency strategies, they do have that expiry date, and missing that window, you completely lose that lever altogether. So we need to make sure that any decisions that we make, they're done ideally years in advance, but at the very least 6-12 months in advance. And there's a few events that come off the back of that, from triggering deemed acquisition, understanding that you're dealing with 2 different tax systems, 2 different tax years as well. So aligning the 2 or optimizing the differences there too. Working with people like Josh to coordinate US exit tax, and also have that extra control with your employer from negotiations too. Whether that's RSUs, whether that's final bonuses, when are you going to receive that? Can you move back? Can you touch your 401k and make some changes to that before you come back to Australia? A lot of this needs to be done prior to coming back. FX strategy as well. And maybe one of the biggest ones, and probably the one that comes to your mind first and foremost, is, well, my family, and actually planning for that as well. So schools, leases, getting the dog back, that could take 6 months to send your pets back to Australia. So we need to have a clear runway ahead of us and a timeline ahead of us that we can actually pull the trigger on all of these different events. So understanding first and foremost the decision to, will I come back to Australia? Yes. Okay. Next, the timeline. Is that in 2 months? Hopefully not. Is that in 12 months? Ideally, and longer than that, the better, realistically, especially the more assets and the more complex your global family is, really. So once we have phase 1 and we've decided our timeline and we decided we're definitely coming back to Australia, then we can start moving into the pre-residency planning window, which is phase 2. So I'll just get you to flick across the next slide there, please, James. Beautiful. So the first point is to understand that your Australian tax residency start date is one of the most important dates in the entire move. Before that, we have the level of control that we need to either choose to sell, restructure, withdraw accounts, distribute from accounts, convert funds, whatever it might be. It's all under your control. Once you're back in Australia, you're an Australian tax resident, deemed acquisition applies, which means that every asset naturally falls under the ATO tax net there, so your worldwide income's assessable. And what this means is that every single asset that you have, it needs a decision, and it needs a decision before you come back. Are we selling? Are we restructuring? Are we holding? Or are we going to withdraw? So the first step that we do here is actually capture your balance sheet. So that's the very first step after phase one, pre-residency planning. What do I own? What's going to be captured upon this return to Australia? Is that going to be, the FX, the cash I have, US shares, RSUs, property, HSAs, all of these different vehicles and probably different type of accounts that you've accumulated for building your life and building your wealth over in the US. Once you have a good understanding of that balance sheet, we can go and start making some decisions there. Now, those decisions come down to understanding, well, how does the ATO treat it and how does the US system treat it as well? So we'll go through a couple of these core ones now, but obviously there's a lot in here. So, we won't be able to get through them all, but we'll see how we go. James, if you could flick to the next one, please. One of the biggest ones I think that comes front and center of everyone's mind is a retirement account. How are these taxed both in the US when I leave and then also in Australia? So, you probably have moved to the US, you probably got offered a 401k or you heard all about the Roth accounts and started out into a Roth IRA as well. And these are great for US retirement accounts, but that decision comes around when we leave around what to do with it. So I always try to start with understanding, well, what's going to happen when I come back to Australia? And it's important to understand that Australia doesn't recognize a 401k as a 401k as it's designed in the US. They recognize it typically under Section 99B of the tax law. Very boring read, but usually foreign investment trusts. And what that means is they break it into two core components. So they see one lens of it as what's called the corpus. Fancy way of really saying capital, generally speaking. I mean, it's basically all of the contributions that have gone into the account, any employer matching contributions, any of your personal contributions. This would apply to things like your Roth or your 401k as an example. Now, all of that makes up the corpus, which means that the remaining balance makes up the earnings component. Now, when we come back to Australia, that is seen under Section 99B, and that means that it's taxed slightly different. So the corpus is tax exempt here in Australia, but the earnings component is taxable here in Australia. So it's taxable not at capital gains tax rates, it's taxable as ordinary income. So you do need to figure out the balance sheet there. You need to make sure that you have historical data to track that. Should you ever get a tap on the shoulder by the ATO to say, okay, well, how do you know how much is corpus? You've got the evidence there. There are things that you can do before you come back to Australia as well to make it more tax efficient too from Australian tax purposes. But it does mean that you have to navigate both systems, because if we're looking at a 401k as an example, and one of these questions I have on the slide here is one account more favorable than the other? So we have a 401k, you pay tax-deferred taxes it's tax-deferred vehicle, so you pay taxes when you make a distribution over there in the US, and you have a Roth where you don't pay taxes, assuming you meet all of the conditions, and that comes out. But here in Australia, they're really both captured under that Section 99B treatment, foreign investment trust. So basically, if you're looking at, well, which one's going to be more effective? I mean, a Roth has gone in after tax, and then it comes out, you pay no US taxes, but you end up paying Australian taxes. So a Roth, is it favorable to keep that if you're retiring here in Australia, or should you consider maybe winding that up or changing to a different vehicle before you come back? So you need to start asking yourself these questions as they arise, and that way you can make decisions around, is it worth keeping my 401k or should I cop the extra penalty tax? Is it worth keeping the Roth account, or can I better use that to free up the capital and buy a property or put it into my superannuation when I come back to Australia? Another retirement account, or a retirement benefit, I should say, that we often get asked is Social Security. Can you keep it? Yes, as long as you're entitled to it, as long as you met your 40 credit points, which is about 10 years worth of contributions for credit points per year. And obviously then you get that. And the beauty of that is it's actually not taxable here in Australia. So it's one of those really, really unique carve-outs in the double taxation agreement where it's completely tax exempt in Australia, which is fantastic. Naturally, in the US, there will still be some withholding tax to pay over in the US. But understanding how is the retirement account taxed in the US, and just because it works in the US system doesn't mean that it's going to work in the Australian system. So that comes down to that balance sheet, understanding do I sell? Do I withdraw? Do I restructure? So understanding that pre-planning option there. Moving forward into some more foreign assets. You just flick to the next one there, please, James. Currency. Look, when you move back to Australia, there can potentially be a Forex event realization one, or Forex realization event one. This comes under the FX currency. Is there a capital gain? Generally, though, if you just move the money over, it's pretty exempt. It's a bit of a risk, though. Naturally, if you've built all your wealth in US dollars and then you come back to Australia and then suddenly the US dollars dropped and weakened significantly against the AUD, you're at a bit of a risk. So that pre-planning, should I start moving money back sooner? Should I start dollar cost averaging and building more wealth in AUD? If that's my home and that's where I should be spending that money, then it could make sense. Understanding that your US shares, RSUs, and former employer stock fall under the deemed acquisition rules here in Australia, which means they effectively get reset for cost-based purposes, so for tax purposes. So that can go for and against you. So if you've got a massive unrealized gain, you beauty, come back to Australia, there's a step up in cost basis, you pay no taxes to the ATO on the history of that gain. Albeit if you're still a US citizen, still US connections, you might have some US taxes when you pay that. But from Australian purposes, if you've got some losses, then there's a step up in cost basis. Those losses are gone forever as well. You don't get to carry them forward here in Australia. So if you do have some losses, it might make sense to, in the years that you are earning income, start to utilize those losses then. So start to realize those losses so they're not just disappear into the ether. Property, it's a big decision as well. What are you going to do with your property? Are you going to keep it, in the US? Are you going to turn it into an investment property? How is it taxed here in Australia? What about in the US? So in Australia, typically, even your foreign property can get the main residence exemption, and in some instances, the 6-year temporary absence rule as well, which means it's less critical for Australian taxation concerns. But, tread carefully because it can go wrong very quickly too. In the US, be mindful of if you are turning it into an investment property, there is sort of 2 in 5 rule. So have you lived in it in 2 of the last 5 years, then you could still be entitled to the $250,000 principal place of residence exemption. So be mindful of that clock and when that starts. Naturally, you need to make some decisions. And also, it's a very big asset. You also become a foreign owner of this investment property, and that can complicate things, especially if you've got debt. Currency comes into play, tax legislation change risk comes into play, inheritance tax comes into play as well. So it can be very messy if you continue to hold US property as a non-resident owner, basically. HSAs, 529s, and Coverdales. There's a lot that goes into these. Typically, they fall under that Section 99B Foreign Investment Trust treatment. I'll just talk about mainly I'll talk about the HSAs and the 529s. HSAs, you can't really use that as a medical expense here in Australia. It doesn't really work that way. So if you're going to use it, try to use it all whilst you're in the US, or you're probably going to end up copping some extra penalty taxes there, unfortunately. So be mindful of how much you add to that in the lead up, and then when you start accessing that. 529s, pretty good actually. You can use that in some qualified institutions here in Australia. So as an example, New South Wales, Sydney, New South Wales University, you can use it there. But obviously check which provider. So just check all of that, make sure that where you intend to spend in, where your children intend to utilize those funds, it's classified as a qualified institution. US trusts and companies. This is a very, very complex area of tax law, and there can be good cases and bad cases. And very, very common in the US to just have a living trust for asset protection purposes tied to your social security number. You can't just retain that and come back to Australia and think it's all going to go just as good and it's all going to flow through to yourself, because it's not. Trusts in Australia are very, very different to the US. They are separate legal entities, and if you hold that, you come back to Australia, then it can fall under Section 99B treatment again. You potentially can get the step up in cost basis, and in some instances, potentially not. So if you have a very large brokerage account, you could be exposing yourself to extra taxes, but pre-planning, maybe unwinding that, or getting a formal tax ruling on the treatment of that and the assets inside can help you, save, in some instances, a significant amount of tax. So complicated area. Make sure you seek advice from the professionals, especially in that area too. We'll jump across to phase 3 now. So Phase one, decision, timeline. Phase two, all about actually actioning, using that lever whilst we have it before we arrive in Australia. Now, day one, back in Australia, we typically become Australian tax residents, and that's when there is this hard switch. And that's because your worldwide income and all your assets are now captured by the ATO as well. The deemed acquisition, I've talked about that a few times. I'm sure you guys have probably read online as well, perhaps about that. But basically, it's when you're deemed to have acquired all of your assets on the value of the day that you stepped off the plane and commenced tax residency. So that becomes a new cost base for all of your assets, and naturally, you have to record that for future CGT events. Really important to document everything. If you can't prove the value, if you can't prove the corpus, then you're not going to be able to get it across the line if you get audited with the ATO or when you submit it with the ATO. You need to have that evidence behind you. So get account statements, get property valuations, get the FX rates as well so that we don't have a massive FX currency gain and when we transfer money back to AUD and now you're paying capital gains tax as well. So we need this evidence, and one afternoon of account statement tracking and record keeping can save you days and days and years and potentially heaps of tax in the future as well, especially things like 401ks if you're a young investor and that's 30 years away. Remember that deemed acquisition don't have all assets reset, like assets inside of US trusts, as I mentioned previously. So this is why that pre-residency planning is core. Now, it's not all doom and gloom because when you come back to Australia, we do have some really good planning opportunities. So, James, I'll get you to just flick to the next one here, please. Great. It does open some doors as an Australian tax resident. And I think one of the biggest advantages is that the fact that it gives you a very clean slate. It's very rare that someone can come back to Australia, have their entire assets have a step up in cost basis or move a significant amount of wealth down, free up all of this capital, and then be free to do whatever they want. They're not tied to a plan when they were 20 years old and slowly accumulating that they have this fresh start. And that opens many doors, and that opens doors to things like Australian entities. They're back on the table. Usually they're off the table whilst we're in the US, but family trusts are back on the table. PTY LTDs are back on the table, and they can work properly if you are no longer a US tax resident. So maybe considering those entities as part of your ownership, things like buying property and debt recycling off the back of that work really, really effectively here in Australia. And maybe one of the most common ones here in Australia that a lot of Aussies take for granted, but that's superannuation. You've probably, if you've lived overseas for 10 years, probably forgot all about it. You probably let it just sit there and sit behind you and built your 401k. And that's very normal, very common, especially when you deal with the complications that the IRS gives to superannuation. But it wakes up and there's a lot of different strategies you can do. If you were timing it over 2 Australian financial years, June, July, you could squeeze over $1 million into your superannuation over a course of 2 months. If you're a spouse, you got a spouse, that's $2 million. If you sell your US property, you got all this capital. Now you've moved $2 million into your $1 million into your respective superannuation accounts, and then you can transition to retirement completely tax-free withdrawals, tax-free growth, tax-free earnings. Fantastic. You can move more than that in if you've got carry-forward concessional contributions as well, so you save some more taxes at the same time. But it really does wake up and becomes a real key pillar in your retirement strategy if you've left it dormant. And that can come in the form of saving taxes or just simply boosting it for your retirement account. Final one here will be a US Australian repatriation checklist. Basically, a bit of a take-home roadmap. Make sure that you time your income carefully. Bonuses, RSUs, deferred comp, these can be sequenced across both tax years. So we didn't really talk about that too much, but think about how Australia taxes things like RSUs versus the US, and then also the differences in marginal tax rates as well. A lot more favorable generally in the US to receive these, especially if you're doing it, say, in January or February, where you haven't earned much income for that year compared to a full year and departing in December, as an example. Executing your FX strategy, don't leave everything up to chance. It's just a risk you shouldn't necessarily take. So transfer wealth regularly back to Australia, dollar cost average that currency risk, build wealth in Australia if this is where you intend to retire, return to. Decide what to do on your US property. Are you selling it? Are you retaining it? And what does that actually look like? And of course, model the fact that you have it to always deal with both sides of the fence then. Review your investment cost basis for that deemed acquisition, document it, keep that record, keep those records for future filing. Plan for your retirement accounts as well. That's obviously a huge takeaway for today is your 401k, traditional IRAs, Roths. They're not treated the same here in Australia. So understand how they are treated and understand what you need to do before you come back. Because once you're here in Australia, it gets a whole lot complicated. Last one is a bit more of, I suppose, your landing obligation. So come back, consider what you're doing back here in Australia in terms of opening bank accounts, getting car registered, getting leases, actually having the money to fund that, streamline your banking as well. So consolidating cash, retain. Typically, we like to retain one US bank account for ongoing obligations. Try your luck. Sometimes they just give you the boot anyway because they don't like non-resident aliens holding US bank accounts. Beautiful. I think that's my last slide there, James. I'll give it back to you, mate.
That was great, Martin. So some terrific insights there, and obviously running through those three phases, locking your timing, as Martin said, that's one of your most important controllables, that timeline upon which you're going to repatriate. Tidy up those assets before you come back, especially given how the Australian side is going to tax them and whether you need to make any withdrawals or move some things, even use the unrealized losses that you might be carrying because you're going to lose them when you're back in Australia. Plan the currency move. As we said, dollar cost averaging, it's the most sensible approach you can take when a lot of your wealth has been built up in, say, the US dollar, but you're returning back to Australia. And then obviously re-establishing yourself back in Australia, your new home, super, investment structures, and obviously the right debt mix as well. Some terrific insights there from Martin. And that's a wrap for part one of our repatriation special. Hopefully that's given you a clearer picture of why timing your move is generally the biggest lever you can control. What to do with those US retirement accounts, RSUs and property before you land, and how to set yourself up properly once you're back on Australian soil. In part two, we hand things over to Joshua Ashman from Expat Tax Professionals, who's going to dig into the US exit tax specifically, who actually gets caught by it, the three tests that determine whether you're a covered expatriate, and a couple of real client case studies that show how this plays out in practice. If you've got a green card or you're a US citizen thinking about coming home, that's an episode you won't want to miss. Thanks again to everyone who reached out asking us to share this one. It's exactly the kind of feedback that shapes what we put out, so keep it coming. If you'd like to talk through your own repatriation plan, get in touch with the team at Atlas. The details are in the show notes, and we'll see you in part two.